Like if you're building the house from scratch, like say maybe you're clear cutting the land, using the trees to build a log cabin because you're like Abraham Lincoln, and you want to, that would be very unpassive. I can't actually think of anything less passive than
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour our old-fashioned real estate advice.
Episode 29.
Welcome back to another episode of the Old Fashioned Real Estate Show. My name is Brian Leverage.
And I'm Jeffrey Holst.
And we're glad to be here with you again today. So we've got a good basic episode. You want to give our listeners a little more information?
Yes. I do, actually.
Please elaborate.
Thank you. So at the Old Fashioned Real Estate Show, we've spent a lot of time thinking about how to help our viewers understand different topics in real estate. And one topic which we've purposely avoided for this whole time is how to get started investing in real estate. And so that's what we're going to talk about today.
Right.
Now, there is a little bit of a method to our madness, because most people would say if you want to get started, you would start at the beginning. Right?
Yes.
And we chose not to do that because we thought that it would be better to cover a series of topics over the last year and then to summarize them in one form in one episode.
Okay.
So that's what we're going to do.
Great. So why don't we jump right in?
Sure. So when you're looking at getting started in investing in real estate, there's a couple of things that you have to understand. And first and foremost is, what's the point? Like, how do you make money in real estate?
Right.
And so we talk about what's called the four sources of real estate returns.
Cash flow from your operations, tax advantages, appreciation, and amortization. So, just to sort of summarize, obviously cash flow from your operations is what's left after you've paid your expenses plus your mortgage. And that goes in your pocket or your bank account every single month. The tax advantages are...
Well, that's things like depreciation, which is reduces your taxable income. It can be things like bonus depreciation that can even reduce your taxable income in some circumstances that you get from outside of real estate. It can be things like capital gains deferment through like 1031 exchanges. And we actually did a video on 1031 exchanges that you can check out.
Sure.
Appreciation is, if you don't know, is when the value of a property that you own goes up. And that could be either forced appreciation, where you create appreciation in some way by either fixing it up or raising the net operating income, or it can be a natural appreciation.
Yeah, natural, exactly. And then lastly is amortization, which is essentially, even if you make no money from your operations, you're going to build equity over time because your principal builds as you pay your loan down.
Right, so as long as you have debt on a property and someone else is paying that mortgage, you're gaining money even if you're not getting cash flow at the time. And so those are the four different primary areas where you get money from real estate investing.
Yeah. A big one is selecting the right asset class. That's kind of our second one. We did that in show 4.
That's right. And just to be clear, though, we also did the four sources of real estate returns. We did an entire episode on that, which was show 5.
Just look up above us somewhere. It'll be
tagged. We're not sure actually what side of the screen it's on, so I'm going to go with over there.
Yeah.
That's probably wrong. But anyway, selecting the asset class is a really important second step. I mean, you decided you're ready to invest in real estate, and then the question is, what type of real estate do you want to invest in? Do you want to invest in residential? Do you want to invest in duplexes, single families, office buildings, stuff like that?
Right. There's not really a right or wrong with these. It's just sort of informational.
Yeah, and we, and like Brian said, we did do a show on this as well, but when you're selecting an asset class, I think some of the things you want to think about are how actively you want to be involved in that particular real estate, what are your level of understanding, and what other opportunities do you have?
Sure. Which kind of leads us to our next one, which we covered in show number 6, which is how passive is your investment?
That's right. And we had a thing called the passivity scale, which is really fun, so you can look at that episode and see that. And again, we'll tag this as well, but on one hand, you might have something like turnkey investing, which is fairly passive. I mean, you do, and we talked about this quite a bit in that episode, but you do still have to do some due diligence. You're still going to have to make sure you have good property managers and things like that. But that's fairly passive. Someone else is finding the deal and also managing that deal for you.
Sure.
And then on the other side is something like going out and constructing a single family home to rent out. That's very unpassive. Like if you're building the house from scratch, like say maybe you're clear cutting the land, using the trees to build a log cabin because you're like Abraham Lincoln, and you want to, that would be very unpassive. I can't actually think of anything less passive than that.
Yeah. Well, Lincoln wasn't much of a pacifist.
No, I mean, he did.
We may want to edit that, but
I mean, listen, Lincoln did a lot of good things. I'm sure he did some bad things too. That's just the way it is.
So moving right along, point 4, which covered in show 7, is should you manage your own properties? And again, not really a right or wrong answer. Everybody's got their own level of comfort. There are advantages and disadvantages to self-managing or outsourcing it. But it is an important decision to make because a good property manager gives you scalability, which frees up your time, allows you to find even more deals, and thus increase your bottom line. Self-managing, on the other hand, does require more time. I think my only argument there with self-management is a lot of people think they're saving money by self-managing, but they don't necessarily always factor in the time element. You know, you should be paying yourself a salary.
You can tell who the property manager here is. So I think Brian might be a little biased towards that. And actually, I agree with him, though. I mean, in most cases...
I actually self-manage in a technical sense.
Well, fair enough. For what it's worth, I think in most cases, as you scale, you're going to need to bring on property management, or you're going to have to build a team, essentially your own property management company, because you can't manage 100, 200, 300 units on your own. On the other hand, I do think if you have one duplex or one single family house, it's worth considering managing it, particularly if you want to scale, because once you manage a property for a while, you're going to be in a better position to hire a property manager. And a lot of that information was actually covered in the show we did on that, on how to manage your properties.
Yeah.
And should you manage them yourself?
I think that's a great follow-up point.
Yeah, so anyway, so another topic which I think is really important when considering real estate is, you know, how to get the most amount of money you can out of your real estate. And one way to do that is by manipulating those 4 sources that we talked about. And one of those directly is impacted by leverage, right? So the more leverage you have, well, it might be by you, but so how to properly leverage, how to figure out how much debt you should have on a property. That is something that we covered in show 9.
Right.
I think that episode went really well, and you should definitely check it out up there. But when you're thinking about leverage, what are some of the things that you think about, Brian?
Well, you know, leverage is essentially your risk in a deal. So the higher leverage you carry on a property or an asset, the more risk you're actually exposed to, and conversely, the lower amount, lower loan to value, so to speak, the less risk in a particular deal. You know, typically banks lend at 80% of appraised value or contracted purchase price. Some will go higher in certain circumstances, and some are not as high. It depends on the lender, and it also depends on the asset class.
Yeah, and I will actually take a little bit of an issue with what you just said. I don't think leverage is necessarily indicative of risk. There are some types of leverage that are inherently risky, of course. 100% financed property, say you're buying a 16-unit apartment complex for 100% financing, that might be pretty risky. On the other hand, if you were buying a large multifamily property with non-recourse financing, not leveraging might be more risky, right? Because if you're putting 20% down versus, say, 50% down, you're risking more capital, right? With really no additional compensation for that.
No doubt. And again, it's a personal decision most people have to make for themselves based on their own risk tolerance and where they're at in their career and age. You know, generally the older you get, the less risk you want to take.
Right. And this is where, you know, you can look back to that 4 sources of returns and you can say, look, I get some amortization gains by taking this additional debt. And in some cases it makes good sense. It's a good use of your equity. Which is why sophisticated real estate investors, something we covered in show 9, will often refinance every 3 to 5 years, pull out some of that additional equity that's built up and use it to buy additional property. Sort of supercharge your return by doing that.
Exactly.
And this kind of flows really easily into what our next show, which was show 10, where we talked about how to control or own real estate with little or no money down. And one of those ways was through leverage. There's some other ways as well.
Sure. You could do what's called a lease option or a master lease option, more specifically, where you have control of the property and the ability to lease that property while not actually having the technical ownership or deed in your name. And what that essentially gives you is the opportunity to test drive the property, much like you would before buying a car, and seeing how it performs. And if it does perform up to what your expectations are, you've negotiated a purchase price on the front end, and you'll go ahead and buy it. You can do owner financing as well.
The lease option thing that you were talking about is a little bit like if you were to rent a 3-bedroom apartment and then rent out a couple of rooms in that apartment. You don't actually own the property, but you're still getting cash flow from those additional rooms that you're renting out. And it's just on a bigger scale, right? You might rent the entire apartment complex and then rent out the individual apartments.
Sure. People do the same thing with sort of Airbnb, where they'll rent a house or an apartment, for instance.
Airbnb arbitrage is a big thing now, they call that. So
exactly.
Maybe someday we'll even do an episode on that. Probably not, because we don't do that.
Point is, there's a lot of creative ways, which we're obviously not going to get into all of those here. Certainly go back and reference our episode 10 for some more of those ideas.
Yeah. Now, this next point is actually the exact opposite of what we've been talking about. But again, I think when you're looking at how to get started in investing, it's really important that you have a pretty broad understanding of the market. And one of the things that's out there in the marketplace are things called syndications, which is really investing in someone else's deal. So somebody puts together an apartment complex deal, they find the deal, they're managing the deal, and they say, I need to raise $500,000, and I'm going to get 10 people to each throw in $50,000, and they're going to get a piece of the deal. And then the sponsor who set the deal up, potentially also takes a piece of the deal, and they get some kind of bonus for being the person that manages it.
Exactly. But what that gives you is the ability to invest in properties, both as the syndicator or the sponsor and as the investor, that you probably otherwise wouldn't have access to were you trying to use nothing but your own assets or capital to buy.
And Brian and I have done a little bit of this. Yeah. Actually, I've done it on both sides. I've put deals together where I've taken investor money in. I've also invested in other people's deals. And in both cases, there have been advantages to me as the investor, and there have been advantages to me as the sponsor.
Sure.
So it can be a really good way to get involved in deals that you wouldn't otherwise be able to get involved in. We did an entire show on that, which started with our favorite tagline of any show that we ever had, and that is, we declared boldly that we were not the mafia.
That's right.
So just in case anyone was wondering about that,
we'll reiterate it again.
Yes, we're still not the mafia.
That's right.
Yes.
That's right. So
that was show 11, by the way. So.
Yeah. Next one sort of ties in with all of this is that, real estate, much like anything else, the business cycle, you name it, real estate also operates on its own cycles as well. And when you're getting into investing, it's kind of important, although this is probably maybe a tougher topic to understand when you're just getting started.
It is, but I think there's so we're talking about market cycles, right?
Yeah.
And in real estate, it's important to understand that this cycle exists. There's going to be times where the market's going up, and there's going to be times when it goes down. Right now, if I were going to guess, I would say we're at the later stage of the market. Now, we've been saying this for a couple of years, right? So there are people I know, and Brian knows, that have been out of real estate market. They've been not investing for 3 or 4 years already, and they've missed out on a significant amount of gains as we sit here in January of 2020. We know that the market has gone up for the last 5 or 6 years, pretty consistently in almost all areas of real estate. Now, what we don't know is when the market's going to go down. But we do know at some point the market will top off and then eventually it'll go back down. And that's really what show 13 was about. We talked about how to predict where we were in the market cycle, how we could look at occupancy levels, and we could see from the direction of occupancy and then the historical occupancy in a particular market where we were in that market cycle. And there's 4 distinct cycles, and there's a lot of science and theory behind it. So you really kind of have to watch episode 13.
Yep.
Lucky number 13. And then you can really understand. And that's actually our most popular episode. We've had more views on that than any of our other episodes.
Exactly.
So if you haven't watched it, why not?
Yeah. And almost as if tying in with everything else, of course, we go down the line. And we're talking about bank financing, which we discussed in episode 18, right? Generally, real estate is not cheap to acquire. And of course, banks and lenders really of any sort play a very important role in your real estate strategy. So,
right, and this is of course related to the leverage concept we were just talking about, but this is specifically on how to get bank financing. So we did a whole show on it. When you walk into a bank, how to present yourself. Don't show up wearing an old-fashioned real estate t-shirt. I mean, you can wear that to pretty much any other occasion out there, and we do have this amazing list of products. There's nothing in between my hands, you realize, but hopefully Cameron will cut that in there somehow so that it will actually make something between my hands. But we have the shirts and we have these great, I don't know if you can see that or not. Cameron will have to take a close-up and cut it in there. But we have these great cups that have our logo on them now, and I think these are only like $7 on our website, oldfashionedrealestate.com. But anyway, you can buy the shirts and stuff, and you should wear those everywhere, and you should give these to your bankers as gifts because they'll really appreciate them.
And better yet, take a picture of it and put it on Facebook and share it.
That's right, and hashtag, OFRS or whatever our hashtag
Offres.
is. Offres, yeah, the old-fashioned real estate show. But anyway, so definitely want to look at that episode. It kind of tells you like what sort of documents bankers are looking for, how to present yourself, how to talk to bankers. And it's really important that you have that credibility going in because first impressions are super important.
Yeah. So last and not least, in episode 22, we discussed forming partnerships and why you need them. Investing, and I think we both agree here, it's a team game. And while there are trade-offs to investing with other people, certainly you have maybe a smaller percentage than you would on your own. Again, it goes back to additional opportunities to create more income.
That's right. And the thing about partnerships is that even if you say you don't invest in partnerships and that you own everything yourself, which you can do, you're still going to have a team sport element, right? I mean, you're still going to need contractors. You're still going to need,
title companies,
things
attorneys,
like that. There's always,
CPAs.
There's going to be all this kind of stuff anyway. But the real advantage to partnerships in general is that it allows you to get into deals that you wouldn't otherwise be able to.
It spreads the risk.
Yeah, it's fine to say, I want to have 100% of it. But the truth is, like, I can go buy, let's say I have enough money to buy one duplex and Brian has enough money to buy one duplex. Yeah, we could each go buy a duplex. Or we could partner together and buy 2 duplexes, or potentially, because we have double as much money, we might be able to leverage that into a quad or a 10-plex or something like that. And also, I can utilize some of Brian's skills and resources, and he can use some of my skills and resources. So we can do more as a team than we can separately. And that's why we think it's really important to do partnerships. And like Brian said at the beginning of this point, we did do an entire episode on that. But that's sort of the 10 things we think you need to know before you start investing in real estate. Now, there's a lot more you need to know, and you should watch all of our episodes. But if you watch these 10 episodes that we just talked about, it'll give you a really good start on where to begin with real estate investing.
Frankly, it's probably more information than most of us were aware of when we all got our start.
Oh, that's right. And I mean, I think you should start investing as soon as you can, but recognize that there's a lot of risk to going into this stuff blind.
Yeah.
And by getting some education ahead of time, you can really
save yourself a lot.
Yeah, and you can definitely reduce your risk because we have this thing called the, what do we call that thing? The risk scale thing? I don't know. We had a thing, we called it something or other, but the basic idea was...
in an episode we can't recall.
Yeah, I don't even think we put it in an episode, actually. But the basic thing is that the risk is mitigated by... additional knowledge, and that can be market knowledge, that can be just general knowledge about real estate. It's mitigated by partnerships, and the more risk you take, the more return you get. In general, that's what people say. But if you mitigate that risk, it doesn't necessarily reduce your return.
And I'd argue, and I think you'd agree, but I don't want to necessarily speak for you, you don't have to be an expert in all 10 of these topics. You just have to have like a base level of understanding.
Right.
Enough so that you kind of understand. And if you understand these on a minimal level, it's going to give you a great leg up over a lot of other people, and you will, I think, have a lot more success. And you're going to, of course, learn as you go along.
This is actually what I meant to say about mitigating risk. The more knowledge you have, the better you're going to do.
Yeah.
And if you watch every one of these episodes, you're not going to be an expert on any of those.
Right.
I don't even think Brian and I are an expert on any
we
of
learn
these
new
topics.
things every day.
But what I do know is the more I've studied each of these topics, the better results I've had in real estate, and this gives you a good place to start.
Yep.
So with that,
on that note,
cheers.
Thanks for joining us.
Make
and
sure
we'll
to buy
see you
some of
again
these
soon.
glasses.